Hello, everybody. At this time, we are talking about market value. Market value is the price an asset would fetch in the market based on the price that buyers are willing to pay and sellers are willing to accept. It may also refer to the market capitalization of a publicly traded company, calculated by multiplying the number of outstanding shares by the current share price. Market value is easiest to determine for exchange traded instruments such as stocks and futures, since their market prices are widely determined and easily available. But it is a little more challenging for often the counter instruments like fixed income securities. It is also difficult to get an objective market value for illiquid assets like real estate and businesses, which may necessitate the use of real estate appraisers or business valuation experts. And then, how is market value expressed? Market value can be expressed in the forms of mathematical ratios that give the management insight into what the company's investors think of the organization, both at present and in the future. The first about earnings per share or EPS. EPS is calculated by allocating a portion of a company's profit to every individual share of stock. A higher EPS denotes higher profitability. Second, price earnings or PE ratio. The PE ratio is the current price of the stock divided by the earnings per share. Third, book value per share. It is calculated by dividing the company's equity by the total number of outstanding shares. Fourth, market or book ratio. The market or book ratio is used to compare a company's market value to its book value. It is calculated by dividing the market value per share by the book value per share. And fifth, market value per share. It is calculated by considering the market value of a company divided by the total number of outstanding shares. And then we move to factors that influence market value. Market value is not static. It evolves with market dynamics, economic conditions, and asset specific factors. Several elements influence the value. The first about demand and supply. The interaction between buyer's demand and seller's supply directly impacts market value. For example, a property in high demand location with limited availability will have a higher market value than one in less sought over area. Similarly, a company's shares can experience value fluctuations based on investors' interests. Second, industry trends. Innovations, regulations, and competition within specific industries also affect market value. For example, technological advancement can increase the value of cutting-edge products while rendering outdated technologies obsolete. Third, economic conditions. Macroeconomic indicators such as inflation rates, unemployment levels, and GDP growth significantly shape market value. A robust economy often boosts consumers' confidence and demand, raising the market value of goods and services. Conversely, market values can plummet during economic downturns as spending power declines. And then fourth, asset-specific factors. The intrinsic qualities of an asset especially, such as its age, quality, brand value, and location play a pivotal role in determining its market value. Intangible assets such as patents or goodwill often enhance the market value of companies in knowledge-driven industries. And then key differences between market value and book value. There are some of the key differences between market value and book value. The first, basis of value. Book value calculations determine the business value by comparing assets and liabilities. It involves examining the company's financial statements and calculating the total value of assets and liabilities. It is a more accurate metric representing the asset a business can sell to recover its value. In comparison, market value calculations use shares prices and numbers to determine the business worth. Share prices can change depending on investors' anticipation of future earnings. The market value reflects the market state more than a business value. Second, about purpose. Investors can use market value to assess the business size and dominance. Companies with a small market capitalization may have more growth potential than those with a more significant market value. Investors can thus compare the growth potential of two companies by comparing their market values. Book values helps investors decide whether to buy shares in a business. They can compare the book value with the market value to identify companies with good financials but have a temporarily low share price. Lenders can also use book value to know how much to lend a business and at what rate. Businesses with a good book value can represent a lower risk to creditors and they may issue loans at a lower rate. And then third, accessibility. The market value uses share prices and the number of outstanding shares in its calculations. This data is publicly available information, meaning anyone can access it at any time and calculate the market value. The primary source of market value is the market. In comparison, book value calculation require you to check the company's quality financial report, usually readily available to shareholders. Most businesses use accounting formulas to calculate their total assets and liabilities. The source of a company's book value is its operations. And then fourth, about timing. The business market value involves multiplying the current share price by the number of outstanding shares. This makes it a true reflection of the current market value, which investors can gain access to, helping them make decisions using recent figures. The book value uses the business quarterly report. Their figures can be out of date if you're doing your calculation using the previous quarterly report. A company can have assets depreciate or acquire more debts during the time gap, affecting the book value. I think it is enough. Thanks for watching.